From 1 October 2010, we will lower personal income tax rates and increase the rate of GST to 15%. The increase in GST has been estimated by Statistics New Zealand to raise the level of prices by about 2%. To put this in perspective, this is less than actual CPI inflation in each of the past 6 years. The government is concerned to protect the vulnerable and those less well off from this one-off rise in the general level of prices. This continues the approach taken in last year's budget, which preserved income support and entitlements in the face of global recession. The tax package will protect incomes of New Zealanders in two ways. First, for income earners at all taxable income levels, the reduction in personal income tax will be sufficient to match the increase in GST. Second, the package will provide, from 1 October 2010, an immediate lift in the levels of New Zealand superannuation, all main benefits, student allowances and working for families payments. This will be sufficient to offset the estimated impact on prices due to the rise in GST. Revenue raised, the payments will be adjusted to ensure the full CPI effect is captured, excluding the CPI impact of the tobacco excise increase. Revenue raised from GST and other base broadening measures will be used to fund an across-the-board reduction in all income tax rates. Mr. Speaker, the changes to personal income tax rates to apply from 1 October 2010 will be as follows. The initial income tax rate applying to income of $14,000 will reduce from 12.5% to 10.5%. The rate applying to income between $14,000 and $48,000 will reduce from 21% to 17.5%. The tax rate applying to income between $48,000 and $70,000 will reduce from 33% to 30%, and the tax rate applying to income over $70,000 will reduce from 38% to 33%. Mr. Speaker, these are substantial and worthwhile tax reductions. They mean that, for example, a typical two-earner family with 2 children who earns the average household income will, after allowing for the increase in GST, be better off by $25 per week or $1,285 per year. When combined with tax cuts already delivered from 1 April 2009, that family is better off by over $43 per week or $2,245 per year. The changes also mean that since March 2009, the marginal rate of income tax faced by taxpayers earning between $40,000 and $48,000, just below the average wage, will have almost halved from 33% to 17.5%. Taxpayers wanting to know how their own position is changed by today's tax package can consult the website www.taxguide.govt.nz and make this calculation. Mr. Speaker, the government believes that in a world of mobile capital, business income is particularly sensitive to tax rates. When New Zealand's company tax rate was set at 33% more than 20 years ago, that rate was competitive by world standards. Since then, company tax rates have show strong downward momentum around the globe. The tax rate applying to New Zealand companies will reduce from 30% to 28%. This will apply from the start of the 2011-12 income year. %28 will also become the standard tax rate applying to most saving vehicles. It will apply to vehicles taxed as companies, including group investment funds, unit trusts, life insurance and superannuation funds, It will also be the maximum tax rate applicable to portfolio investment entities known as PIEs. Lower income taxpayers will still have access to lower rates via imputation credits from companies and electing lower PIE rates. The tax rate applying to trusts will remain at 33%, the same as the new personal top rate of income tax. The previous gap between the 33% tax rate for trusts and the 38% rate for higher income individuals has spawned widespread use of trusts as tax planning vehicles. Trusts have an important role in our economy, but this should not be driven by tax advantages. Applying a lower and more uniform tax rate to most forms of capital income will improve the durability and the integrity of the tax system. It will encourage individuals to save and companies to invest. Mr. Speaker, the Tax Working Group also reported that anomalies arise through the use of taxable income as a means of determining eligibility for certain government assistance. Taxable income may not always be a good measure of the true economic circumstances. As an initial step, from 1 April 2011, investment losses will be added back to taxable income for the purpose of determining a family's eligibility for working for families assistance. Further changes of eligibility for government assistance, including student allowances, covering areas such as distributions from trusts and income from cash pies, will follow after the budget. Officials will release a paper setting out the issues and proposed solutions later this year for implementation from 1 April 2011. Mr. Speaker, this budget will also introduce a range of measures to broaden tax bases. These measures are being introduced to improve the fairness and the efficiency of the tax system and to improve the economy. The existing 20% loading on depreciation for new investments will be removed for assets acquired after today. Assets already purchased will continue to receive the loading. This allowance explicitly departed from the principle of allowing deductions for true economic depreciation. It results in other taxpayers effectively supporting investments that might not stand up on their own merits. In addition, the government is not convinced that all buildings actually depreciate. It's clear that some do, but many New Zealanders live happily in houses constructed over 100 years ago. Allowing tax deductions for depreciation provides an unfair tax advantage for these assets. Accordingly, the depreciation rate for most buildings with an expected life of 50 years or more will be set to zero from the start of the 2011-12 income year. Those buildings where the current depreciation schedule is consistent with a useful life of less than 50 years will be unaffected. Building owners who believe that under these rules a class of buildings should qualify for depreciation may seek a provisional rate from Inland Revenue as they do at present. Following the budget, the treatment of commercial building fit-out will be reviewed and, if necessary, amended prior to 1 April 2011 to clarify the law on the split between buildings which will not be depreciable and separate assets which will continue to be depreciable. Taxpayers will, of course, still be able to claim deductions for repairs and maintenance. Many investors hold property through loss attributing qualifying companies, or LAQCs. After a short period of consultation, legislation will be proposed so that from 1 April 2011 all LAQCs will be taxed as limited partnerships. The main impact of this change will be to ensure both profits and losses are assessed at the marginal rate of the investor. The government has also reviewed taxation of inward investment into New Zealand. International tax law generally provides that income should be taxed in the jurisdiction where it's earned. However, it is relatively easy to transfer income between jurisdictions by use of debt, often between related parties. New Zealand, like most countries, operates thin capitalisation rules to limit this practice. The current safe harbour limit for gearing on foreign-owned investments will be reduced from 75% to 60% from the 2011 income year. Mr Speaker, the package of tax changes represents a major step forward